Good afternoon, good evening, everybody. Thanks for being here again. Thanks to Nadex for allowing us to speak to you. My name is Bob Iacchino, and along with my co-founder, Mike Arnold, this is Trading the Null Point in Nadex Spreads. So let me go ahead and get started, but before we do, we always want to read something that we take very seriously, which is a risk disclaimer. This presentation is for information purposes only and does not constitute investment advice, nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. This presentation is not intended for solicitation purposes, but only for use as general information. And all descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. Past performance is not indicative of future results. Anybody know what that means, that last part? Past performance is not indicative of future results. When you think about that, people call this a risk disclaimer. I called it a risk disclaimer, but it's really a risk statement. It's a statement of risks. And what that last part means, I think, is misleading to a lot of people, because if you think about it just in a normal conversation, if somebody says to you, this investment has performed well, your mind immediately goes to it's going to continue to perform well, or it has the opportunity to perform well again. But what past performance is not indicative of future results really means is that just because something made you money the previous time you did it, doesn't mean it's going to make you money this time. And that's really the key. That's really the part of this that you need to understand. Other than consider the amount that you should risk and consider your own financial situations. When you guys find something where it says it's winning 70% of the time, or it's winning 90% of the time, or we've won our last 100 trades, the tendency is for people to take that information and dump a lot of money into the next one. And inevitably, Murphy's Law, that's the one that loses. Because even if something is 80 or 90% probable in terms of a winning trade, and I haven't seen many, if any, of those, even if something is 80 or 90% probable, there's a 10 or 20% chance of loss. And you have to know that the last trade does not mean the next trade is going to work. And the last investment does not mean the next investment is going to work. So always take these things seriously, okay, and deal with people that take them seriously. We are Path Trading Partners. I mentioned that I'm the co-founder along with Mike Arnold. And what is Path Trading Partners? Well, it's a trading and education firm. And our mission was to form a trading firm that educates, supports, and backs traders who are committed to probabilities, discipline, and long-term trading success. Kind of goes along with what I said about the risk statement. This is achieved by following the correct path. We are not high-frequency traders, and we are not day traders. What we are is a firm that believes in a long-term success in trading, covering time frames dictated to us by products, markets, and price action. Mike Arnold is a 24-plus year market veteran, and he's been teaching traders online and in person for 10 years, over 10 years. Mike is basically a professional devil's advocate. He's a strategy and development consultant to multiple hedge funds. That's something he does outside of Path Trading Partners. That means that a hedge fund will have a strategy, and they'll develop it, and they'll say, okay, we need to find out what's wrong with this strategy, where the holes are. Let's send it to Mike Arnold, and Mike will try and poke holes in it. He's a former options market maker on multiple exchanges, and he's traded in Chicago, New York, Switzerland, and Canada. He is the current head of technology and trading systems development for Path Trading Partners, again, along with being my co-founder. That's me in the top right-hand corner. I've been around for about 24 years. I've been in every market, essentially, equity markets for myself and friends and family, and professionally in commodities, futures, and FX. I've been teaching and mentoring traders both live and online since 2002. I've been an analyst, a proprietary trader, and a fund of hedge funds principal, as well as being a member of the investment committee to that fund of hedge funds, which is where I believe I add value to your path. And to date, I've taught and mentored over 5,000 students. I have appeared and continue to appear on all of the financial news channels. I still appear about 5 to 10 times per month, and I've done about 700 interviews to date. It's probably more than that at this point, but this is not interesting at all. So let's talk about what we learned in the prior classes. And again, I always do this. If you haven't seen the prior classes, you should probably take a look at them, and they can be found basically here. If I put up this website, which is nadex.com, you go to Learning Center, you go to Webinar Archives, and you'll see the archives up here. And speaking of archives, there are storms in Chicago right now. So if by any chance we lose power or lose internet or go silent, we will be able to post a prior version of this particular subject matter in that same place I just showed you. But in prior classes, we covered the concept of moneyness as classifying a spread as either in the money, at the money, or out of the money. That's what ITM, ATM, or OTM stands for. We taught the concept of spread premium and looked at how to determine both intrinsic value and extrinsic value. We taught the Greeks, what they are, and how they apply to Nadex spreads. If you need to learn these concepts, please watch the recordings of our prior Nadex spread classes after this webinar. Again, this is the same link essentially. And after learning the Greeks, most traders wonder how they can effectively translate that knowledge and that information into useful and actionable trading information. And this is what we're going to do when we look to trade Nadex spreads at the null point. However, first we're going to do a very brief review to ensure everyone is on the same page. So, at the money spreads. In a prior class, we reviewed the situations where a trader should consider trading a Nadex spread at the money. Please watch that class if you haven't seen it yet once we're done here. It will complement this class and help you become a more complete spread trader. Because in this class, we're going to investigate trading a Nadex spread at the null point. So, what is the null point? We refer to a Nadex spread being at the null point when the price of the underlying is trading in between the floor and the ceiling price for both a long and a short spread. This is the price where the spread is trading in the money with only intrinsic value. There is no extrinsic value at the null point. Okay, that's an important point to take in. So, if the US 500 is trading between the floor price of 1900 and the ceiling price of 1940, then we consider the spread to be trading at the null point. Remember, it needs to be exactly in between the two. So, if the floor price is 1900 and the ceiling price is 1940 in this particular US 500 spread, and the S&P 500 E-mini is trading at 1920 spot zero, it is considered to be trading at the null point. Again, the null point is where there is only intrinsic value. There is no extrinsic value at all at the null point. Same thing on a short spread. This is the exact same spread. If the US 500 is trading between the floor price of 1900 and the ceiling price of 1940, then we consider the spread trading at the null point. It's the same for a long spread and a short spread. They're identical. So here you see the 1900, 1940. This is the risk graph. Okay, here is where that's the floor price of the 1940. It's inverted in this direction because we're talking about a short spread here, not a long spread. This is the ceiling price, 1920, the S&P 500. It is now trading at the null point. So what makes up Nadex spread premium? And we've talked about this at length in some of the other webinars. Nadex spread premium is made up of intrinsic value, which is the absolute value at expiration, wherever it is. Whatever that value is, that's the intrinsic value. Intrinsic value can be zero. It can be the full cost of, or the full difference between the floor and the ceiling price. Extrinsic value is essentially time value. Okay, that's what goes into Nadex spread premium. So let's talk about the Nadex spread Greeks because they're going to be important in talking about the null point trades. We can apply these Greeks to Nadex spreads, and the definition of each Greek is as follows. Delta is the sensitivity of the spread price to price changes of the underlying. Gamma is the sensitivity of the delta to the price changes of the underlying. So how quickly or how much does the delta change as the underlying moves? That's gamma. Theta is the sensitivity of the spread price to the passage of time. Okay, what happens to the spread price when there's a 2 o'clock expiration and we've gone from 12 noon to 1 o'clock. What has happened? Whatever has happened, that is expressed in theta. Vega is the sensitivity of the spread price to changes in the implied volatility of the underlying. Rho is the sensitivity of the spread price to changes in the interest rate. Now, we're not going to be looking at Rho since we're trading spreads on a short-term basis, and Rho will not affect the price of the spread the majority of the time. It's going to be extremely rare that you're in a trade and all of a sudden there's a massive rate change that affects the math of the pricing models. It's just not going to happen often enough to go into it. So let's go back into one of the components of the premium of a Nadex spread, and that's extrinsic value. What makes up extrinsic value? You already know what makes up intrinsic value, okay, and that's the value of that particular spread at expiration. So what makes up extrinsic value? Well, time until spread expires. That's the theta. That's one component of extrinsic value. And the volatility of the underlying, or Vega, that's another component of extrinsic value. Again, Rho would normally be included in this conversation, but there's no need to include it because it's short term. So the changes in interest rate, essentially they're not going to happen. You're not going to be affected by what you're trading. So the real components of Nadex spread extrinsic value is theta and Vega, time until the spread expires, and volatility of the underlying. So in this session, we're going to examine in depth how time, theta, volatility, Vega, market direction, and momentum affect Nadex spreads when trading them at the null point. Now this session will only focus on trading the Nadex spread at the null point. Other path trading partners sessions focus on trading them at other locations. Okay? This one's going to be only null point. We will also mainly be focused on trading the spreads from the long side for the point of simplicity, although all the information we present directly applies to trading the same null point spreads from the short side, okay, because it's right in the middle. You saw on those risk graphs, null points at the identical place. We're going to focus only on long trades. This is already 51 slides long. So if we had to go into short examples as well, we would lose you guys. You guys would fall asleep. So we're just going to do long examples and know that all the information presented applies to both sides, a long trade and a short trade. Many traders look to trade spreads when they are at the null point because they look at the reward to risk. And they see they can get close to 1-to-1 reward to risk. That's true, but the trader needs to understand that market conditions that are best suited to initiate these kind of trades. What conditions gives you the higher probabilities of these trades actually working? Just trading a spread because it looks like your reward to risk is close to 1-to-1 or better than 1-to-1 does not necessarily make a good trade. Once you understand the market conditions that can be beneficial to putting on a Nadex spread when it's trading at or near the null point, you'll be one step closer to becoming a complete spread trader. So again, here's a risk graph. Now again, illustrating where the null point is. The blue line represents the spread at expiration. Regardless of where the underlying is, you touch the blue line and that's what it's going to be worth. This example is US 500 2000-2010. Here you can see at expiration at 2010, at 2000, okay, it's essentially worth 0. And at 2010, again, same thing. It's worth the full value, which is 10 for a long trade. The null point is dead center of that. Now look at 120 minutes left to expiration. The price is much different. Why is that? Well, that's because there's extrinsic value at these points. When you've got 120 minutes left, it's not all intrinsic. At expiration, it is all intrinsic. So for example, if the spread is the underlying is at 2002 with 120 minutes left, you go straight up and it's worth somewhere around a little bit over $3.50, right? Whereas you go to here and it's about 8. If it's at about 2010.50, it's worth about 8. Again, this is with one volatility, with volatility not moving. So this green line represents a single volatility extrinsic value, and the blue line represents at expiration. Where's the null point? Well, it's at the same place. And you notice that right here, the green and the blue line intersect. That's because why? The green line represents extrinsic value. The blue line represents intrinsic value, or no extrinsic value. What happens right here? The extrinsic value is nothing. It doesn't exist at the null point. And that's one of the points we're trying to get through in this. I'm going to turn it over to Mike now to take over.
Great, thanks Bob for that introduction and the good explanation of the null point. Hope everyone can hear me okay. All right. So when trading Nadex spreads exactly at the null point, there's no extrinsic value. All the values is intrinsic. Also, I want you to remember that extrinsic value, and we've covered this in past webinars as to why it occurs, but it can be positive or negative. Okay, that's why on this slide, let me just jump back there. See, intrinsically, as Bob went over, so you can always go on this blue line and figure out what the intrinsic value is because it's essentially the expiration value. However, down here, prior to expiration, like if you were at the money, long at the money, 2,000, you know the spread at expiration is going to be worth 0. So intrinsically, it's worth 0. All this value, why it's worth $2 and let's call it 40 cents prior to expiration with 120 minutes to go at a specific implied volatility is because that's the extrinsic value. Well, up here, let's say at 2010, when it expires, it's going to be worth a full 10. But however, you're buying it at a discount. You're actually looks like we'd be paying about $7.80 with this implied volatility with 120 minutes to go. So the extrinsic value is negative, all right? In this area above this null point, when the extrinsic value is negative, we call this area where you capture because the theta is working for you. Every minute that passes, your theta is actually positive and you're gaining it. Here the theta is negative and you're losing it. Here there is no theta because we're at the null point, and as long as the underline sits right here, you're not going to make or lose anything if volatility, implied volatility, or time changes because there is no extrinsic value. So if you're trading a spread slightly below the null point for a long trade, there's very little extrinsic value. The majority of the value is intrinsic value, but there is some extrinsic value slightly below the null point. And the farther below the null point you go, the more and more extrinsic value you get. If you're trading the spread slightly above the null point price for a long trade, the majority of the value is intrinsic and the extrinsic value is negative. Since either all the value or the majority of the value is intrinsic value right above or below or at the null point, time does not have a large effect on the value of the spread. So if price action is stagnant and not moving further into the money, then unlike at the money trades, the passage of time does not affect the null point spreads trader position. And we're talking about right at the null point or very close to it. This is true no matter how much time is remaining until the spread expires. Remember, theta is the time decay of the spread. So theta can help or hurt the spread trader depending on where the spread trade was entered. But as long as the underlying price remains at or very close to the null point, theta does not affect the price of the spread. If the trader is long the spread at the null point and the underlying trades back down towards the floor price, then time decay is working against the trader and eroding the extrinsic value. However, if the trader is long the spread at the null point and the underlying price moves closer to the spread ceiling price, then the time decay is working in the trader's favor. And that's where I call it you're now in the theta capture zone. As the spread approaches expiration, the time decay effect is more pronounced at both the floor and ceiling prices. So it can hurt you more rapidly or it can help you more rapidly. Here's what we're talking about. Here's all your times to expiration, including expiration, which is still the light blue line, at the null point. If we put it on here and the market, the underlying just goes quiet, you know, it might just trade either side of this back and forth. There is no time decay virtually because, and if it stays right at the null point, there absolutely is no time decay. You can see all these lines cross. It does not matter if you put it on at 120, 90, 60, 30, 15, 5 minutes. However, if you're down here at the money, look at what happens to your spread as it approaches expiration. And it accelerates more and more rapidly as you get closer to expiration. You lose that extrinsic value more and more rapidly. Up here, at the ceiling price, you actually gain that time more and more rapidly, and the spread increases in value even if the underlying doesn't move. Here's what the graph of theta looks like. And we've gone over the Greeks before in prior webinars, and here's the graph that we've looked at before. So you can see right at 2005, theta is 0. Why? It's at the null point. So there is no time decay. This is where theta, below 2005, the farther down you get, here's at the money, 2000, you can see your theta is really negative. That's why this collapses down, because it eats away at the extrinsic value. It makes the extrinsic value less and less and less with every minute that passes. Up here, here's the ceiling, your theta is positive. It actually adds to the negative, it adds a positive value to an extrinsic value that's negative. So your extrinsic value gets smaller and smaller, and that's why this approaches. See, this would be, at this point, let's say 120 minutes to go, or let's just pick an easy one. 2010, about 90 minutes to go, let's say it's worth 8. So intrinsically it would be worth 10, extrinsically it's worth -2. Well, every minute that passes, you're adding a positive value to that -2, so it gets less and less negative with every minute that passes. So with 60 minutes to go, what was -2 at 90 minutes to go now looks like it's -1.5. At 30 minutes to go, it might be -1. At 15 minutes to go, it's -0.7. So you can see how that's because you have your positive theta up here at the ceiling price and your negative theta at the floor price, and it does not change at the null point because there is no theta. And as I mentioned also, theta versus time. You can see here's your time to expiration. At the null point, it does not change. It's always 0. But at the floor price, it gets more and more and more negative as it gets closer to expiration. See how this gets steeper and steeper and steeper? So the theta has a more negative effect the closer it gets to expiration. The opposite is true at the ceiling. It has a more positive effect the closer to expiration. And you can see how it actually accelerates. See how this dark green line and then the next light green line, so 120 to 90. It's so just a little change. 90 to 60 is a little bigger change. 60 to 30 is a bigger change. 30 to 15 is a bigger change, and 15 to 5 is a huge change. Same at the negative side. No change at the null point, though, because there's no extrinsic value. So what kind of market conditions are good for null point spread trades? It's one of the most lenient places a trader can enter into a spread trade. Why? There's no extrinsic value. Since all or nearly all of the value is intrinsic, there is little or no time decay. This also applies to Vega when trading the spread at the null point. Why? Because there's no extrinsic value, so implied volatility changes don't affect the extrinsic value because there is none of it, and it therefore doesn't affect your spread price. It affects it at other places, but it doesn't affect it while it's at the null point. Increases or decreases in volatility, or it should say implied volatility, do not affect the spread at the null point since it is intrinsic value only. However, keep in mind that as the spread moves away from the null point, theta and Vega do come into play. Since theta or Vega do not come into play at the null point, what market conditions should a null point spread trader consider? The null point is one of the most flexible locations to put on a spread trade. Time to expiration can be long or short. All right? It depends once it starts moving in your direction or moving against you, the time to expiration. But when you put it on, and if the underlying just sits there, your time to expiration does not matter. Volatility can be high or low. However, we do require that some kind of trend be present. You don't just want to put on a null point spread in conditions that you will think will remain stagnant. If it doesn't move, you're not going to make anything, you're not going to lose anything, but you're not going to make anything, which would be the point of putting on the trade, because you have some kind of belief that you are going to make something. Versus if you go to that theta capture area, and we'll cover that whole in depth in a future webinar, but I'll just touch on it right now. If the underlying doesn't move and you're up at the ceiling price, remember you could put it on at a discount, and then that time works for you. So if the underlying doesn't move, you can still make money. All right? Versus if you put that spread on at the money and it doesn't move, now that time's working against you. So that's really bad, because now are you not making money if time doesn't, if it doesn't move, or not making money or not losing money like at the null point. But if you put it on at the money and the underlying doesn't move, you're going to be losing money. So that's not lenient at all. Now, for a long null point spread position, the market should be trending upwards. Why? Because we don't want it to just sit at that null point. For a short null point spread position, the market should be trending downwards. The strength of the trend is important for selecting the expiration of the spread. The strength of the trend is also important for selecting the ceiling price for a long spread trade or the floor price for a short spread trade. In slower trending market conditions, a ceiling floor price that is closer to the null point should be chosen. Conversely, in strongly trending market, a spread can be chosen with a ceiling floor price that is farther away. The strength of the trend also affects the spread expiration time that the trader should choose. For example, for a long null point spread trader in a strongly trending market, a shorter time expiration should be considered. Why? Because you don't want to have it, you don't want a lot of that theta left on the clock, really. Since it's moving strongly, you want that time decay to be working for you as it approaches that ceiling price. Okay, because as it gets closer to closer to expiration, there's not as much of that extrinsic value, so you're really capturing the most of that spread that you can. Whereas if it's strongly trending and it goes to the ceiling price and then just sits there for a while, then starts moving back against you, first of all, yes, you'll still be capturing the theta, but you haven't captured that full value of the spread because that theta didn't kick in yet. Now, in slowly trending market conditions, a longer time to expiration should be chosen by the trader. Why? It's going to slowly move towards that ceiling, and if it's slowly, that's going to start working for you, and you have more time as trends there slowly. Now let's take a look at the spreads in Vega. So we've already considered that Vega does not affect the spread at the null point. Vega, again, is implied volatility component of the pricing model. However, in high implied volatility conditions, when the extrinsic value is at a premium, the trader should consider trading the spread at the null point. This is because the trader will not be paying for the extrinsic value when entering at the null point. So see, here's the Vega component. Here's a graph of the Vega. This would be at the money. This is for a long spread. This would be at the money. This would be slightly out of the money, below the floor price. Here's the null point. This is at 35% implied volatility. Here is at the ceiling price. So you can see how at the ceiling price, Vega increases implied volatility work against you. Near the floor price, implied volatility rising works for you. At the null point, it doesn't affect you. Again, null point, no matter what the implied volatility is, doesn't change the price of the spread. Now, why I like it in high implied volatility is because with really high implied volatility, you're paying a huge premium. So that time decay, if the market goes stagnant, or if it goes stagnant and implied volatility goes down, now time decay is working against you and implied volatility is working against you. So when we're in really high implied volatility conditions, I do not like to put spreads on down at the money or even slightly in the money. I like to put them on up here. And then if it's already high and we start catching a trend, all right, we're on this dark green line. And then as it starts trending, and if it starts trending and implied volatility remains the same or even starts going down, look at what happens. Implied volatility starts going down and we start trending, and that can happen in a nice orderly trend. Maybe we had a big market sell-off. In big market sell-offs, implied volatility tends to get very high. Well, let's say we form a bottoming location of bottoming formation, and I can get on, well, it's still really high. I can get it on at the null point, so I'm not paying for all that extrinsic value. Then we start recovering slowly, and we start working, we start reversing that downward move. Well, as it starts trending back up, that implied volatility starts dropping. Now the trend's working for me, and that implied volatility is going down, and time's working for me. So that's why I love to put those kind of conditions on at the null point. Vega versus time. This is, so you can see how the effects of time work with Vega. As time gets closer and closer to expiration, the effects of volatility lessen and lessen. Why? Because there's not as much potential outcomes. So even at high volatility with very little time duration, they will not affect the spread price that much. That's what I want you to take away here. So you can see the effects of implied volatility at the money lessen and lessen as a negative, as a positive effect for you. Because remember, it helps you if you're long at the money, but the effects get less and less as it gets closer to expiration, and the effects don't hurt you as much if implied volatility goes up and it's really close to expiration when you're at the ceiling, but you don't have to worry about it at this null point. It's important that the trader understands the delta of trading a spread at the money. The delta is the amount of the spread price will move in relationship to a 1 point move in the underlying. So if the delta is 0.5, the spread price will increase or decrease half as much as the price of the underlying. When trading a spread at the null point, the delta is always the highest it will be for the spread at any given time. As the time to expiration becomes closer, the delta will rise and approach a value of 1. So when the trader is trading a spread at the null point, the spread will change at a greater amount both up and down than any other point on the spread. Here's a graph of the delta versus time. So you can see, let's focus on 120 minutes, that's dark green line. So no matter where you have the spread on, here's at the money, here's the null point, here's the ceiling price. The delta is highest at any given time. So if you want your spread to move the most with the underlying, you want to get it somewhere on close to this null point. Okay, you can see how it's highest until we get right down to the really close to expiration. You know, it branches out a bit where all this is really close to 1, even with 5 minutes to go. But right around the null point, it's all pretty much moving 1 for 1 with the underlying price. So that's what I want you to take away. If you want your spread to move, especially closer to expiration, so if you're in a strongly trending market and you want to capture, you know, this is going to move at most 1 for 1 with the underlying, closer to expiration, somewhere at the null point, that's where it starts, the delta really starts kicking in. More considerations for null point spreads. Since we're trading a null point spread either at or very close to a 1-to-1 reward to risk ratio, we should plan on having a stop out level and not taking on the full risk of the spread. In other words, let's say we enter a $100 spread at a price of $50. We therefore have a risk of $50. We should have a price level based on the price movement of the underlying where our assumptions are incorrect and plan on exiting the spread at that point. To continue our $50 entry example, let's say we entered a long null point spread because price was trending up and implied volatility was very high. However, a short time after entering the long spread, the price of the underlying sharply reversed and broke a critical price action support, therefore nullifying our reason to be in the long spread position. Instead of taking the full risk of the trade based off the underlying trading below the floor price on expiration, we should exit the spread when the critical support was broken, taking a quick loss and not risking the full $50. Remember, as it goes down towards at the money, now your time's working against you, price action's working against you, your time decay is not helping. If implied volatility starts dropping, that's working against you. So if I'm doing something at the null point, and it's, you know, it's fine if it goes slightly down, that doesn't bother me. But if it really breaks a critical level and starts trending against me, and the other conditions like time cannot be working for me at the money, and if I see implied volatility goes stagnant or starts dropping, I'm out of the trade. I don't want it anymore. There's a better kind of trade to put on in those conditions. Non-optimal conditions. We've just outlined some of the conditions we're looking for to consider entering a Nadex spread at the null point. Let's rephrase them and look at what non-optimal conditions would be. We are not looking to trade null point spreads when the price movement is stagnant and not expected to move. You're not going to lose anything, you know, if price action really goes stagnant right around that null point, or you could lose a little, you know, if it just goes slightly against you, but you're not really going to make anything. So if it's going to be stagnant for a while, let's say you're waiting on something, you like the price action is quiet for a reason, but then you think it's going to kick in and trend in your direction, that's fine. But if it's like after hours trading or lunchtime trading and it's really stagnant and that spread's going to expire and those conditions are still going to be present, there's no real point in putting it on at the null point. We're not looking to enter null point spreads if the market is expected to move or trend against our position. There's no benefit to that. We can enter a null point spread during slow market conditions if they're expected to pick up well before expiration, but we should not enter soon to expire spreads at the null point during very slow non-trending conditions. Examples of non-optimal conditions. Some examples of when we would not consider putting on null point spread trades: early evening trades in currencies, and usually in equity indices and commodities when prices tightly range bound and not expected to break out. A short time before a major report release. For example, putting on a null point spread at 1:45 p.m. that expires at 2 p.m. when there's a major Fed announcement that is expected at 2 p.m. and price action has gone dormant. There's no point. I'd more likely put on a Theta capture spread at that point because time's working for me. Let's give it back over to Bob and he can go through an optimal example.
Thank you, Mike. So again, Mike talked about optimal examples and non-optimal examples. So let's actually go over an optimal example. Shortly after the opening of the CME E-mini S&P 500, Pat trading at a multi-time frame divergence signal to go short the S&P 500. Based on implied volatility conditions and a Fibonacci retracement extension target, we decided to go short a Nadex spread at the null point. At the time of the signal, price action was in congestion, so we opted for a longer expiration spread. And the following charts review this trade. So obviously this wasn't the last couple of days because you can see where the price action is. But this was on or about February 23rd. And we were looking to go short a Nadex null point trade. Now here we had higher highs developing and a falling RSI. Implied volatility was stable, and the trade triggered at about 9:40 a.m. with a valid close triggering multi-time frame divergence. I'm not going to go into the strategy, but this particular divergence was on multiple time frames, so we call that multi-time frame divergence. Now our price action stop level was identified to be above 1938.50, above it, not at it, but above it. Okay. And a single target of 1920 spot 70 identified based on a Fibonacci retracement extension. So due to range-bound price action, we chose a spread that expired at 4:15 since we were not sure when price would break lower. Okay, we were in congestion. We wanted a little bit of time on this one. The spread was sold at 1935 spot 20 for a max profit of 152 and a max loss of 148. We didn't quite capture this. The null point exactly of this particular spread, this 30-point spread, is 15 basis points above, so 1935. So the price entered it in 1935. We were able to get it 20 cents more than that. So the actual $2 extra potential max profit was put in there. We're really looking to put it on exactly at that point, but this little blip got us 20 cents higher. That's okay. That's not meaningful difference to where the extrinsic value was going to change dramatically. So this essentially was a null point short. Now we talked about it from a long perspective. This will give you an example of the short having the exact same type of information being used for the trade. So the spread was sold at 1935 spot 20 for a max profit of 152 and a max loss of 148. With a target of 1920 spot 70 was reached approximately 90 minutes later, so we closed out the spread. The spread was covered at 1924 spot 60, resulting in a profit of $106. Now, a lot of people will wonder, well, why didn't you just hang on to them? We'll get into that in a second. We always our trades when a target is reached, okay, regardless of what the volatility's done or any of that, because our particular targets are price action based, and you can see very strong reactions at the target. Here was the 1920 spot 70 or 71 essentially, Fibonacci extension, the retracement extension. Here's where it was, and you could see the price action responded. Did it get a little bit lower? Yeah, it did. But before expiration, it actually rallied back up after reacting strongly to that level. This particular pattern is why we chose that as our target. We always exit trades when it reaches our target. We had a potential max profit of 152, and as it's stated here, we ended up making 106. Same happens on the other side of the trade, okay, where our stop was not going to be expiration, okay? The stop level was going to be above 1938.50. So while we had a max potential loss of 148, it's likely that if we had gone to our stop, we would have exited the same way we did our target, okay? And we would not have incurred the max $148 loss either, all right? But this is a visual example of why we do that. We get that question all the time, so we decided to include it into the presentation. Let's look at another optimal example. With a minute 52 left in the trading day of the S&P 500, we received a trade signal based on a close beyond a path trading trend line. Earlier in the day, implied volatility was rising with the market sell-off. Implied volatility had begun to drop a bit, but was still relatively high. So we chose to target a long Nadex spread trading at the null point. So here again, this is the very next day. All right, you've got a list of the spreads that expired. We chose an 8 a.m. to 4:15, 1900 to 1930 spread with approximately 1 hour and 52 minutes left to expiration. The underlying was trading about 1914.50. Okay, you can see that right here on the indicative index. We were able to get the spread on at about a price of 1914.70 for a total risk of 147 and a potential reward of 153. Our target, based on a past significant level, was 1928.80, which lined up nicely with the ceiling spread of 1930. Our stop level was 1901.9. Our target was reached at 340, so again, we immediately closed our position. You can see on the chart here, there's the target line, there's where it was reached. You can see two reactions already on this chart. And this led to a profit of $125. Again, we had a potential max profit of 153. By the time it got up there, with a little bit of extrinsic value working against you, as it goes into profitability, it led to a profit of 125. Again, the max loss of 147 was only a max loss. It wasn't the loss we were going to take if it went down through our stop. But this led to a profit of 125. Okay, again, you can see the little reaction we had here already. The market went up, tapped the level, fell back, came up, touched the level, and struggled a little bit to break through it at the time of this particular screenshot. So in this webinar, we covered various aspects of trading null point Nadex spreads. We examined how some of the Greeks affect the spreads. We also looked at the optimal and non-optimal market conditions, which can help a trader determine when to trade a spread at the null point. You will probably need to review this information multiple times and then determine how this information can work to further help you successfully trade null point Nadex spreads and include your trading strategies with that. Okay, you guys have to remember, you have to have a trading strategy. You can't just be saying, I think it's going up, I'm going to go ahead and go long a spread, and this one looks like it has good reward to risk. Okay, you can't do that because that doesn't work. So you have to have a trading strategy, and then you have to see the optimal market conditions to affect that trading strategy. Again, we are Path Trading Partners. We're going to stick around for some questions if you guys have any. But in the meantime, follow us on Twitter, @PathTrading, @Path_trading. Like us on Facebook, and visit us at pathtradingpartners.com. Sign up for a bunch of free stuff. There's a bunch of free stuff on there. We'd love to have you buy something from us, but we don't care if you do. Okay, just sign up for the free stuff, and we'll let you know whenever we've got something else coming out. And my favorite, please listen to our podcast, The Money Path, which can be found on the website. You go to Path Trading Partners, you'll see a section where it says podcast, and you drop down, and you can listen to our podcast. We discuss a bunch of stuff on that podcast, not just Nadex, not just futures, not just commodities, but stocks, and to a certain degree, some fundamental stuff that we don't normally talk about. So, again, thanks to Nadex for having us, and we'll stick around for questions if there are any. Maybe this was said before, but is ATM same as the null point? Mike?
At the money, and we covered this in a prior webinar, so you want to go back to review that. That's for a long spread. At the money is when the spread's just about to go from all extrinsic value to partial intrinsic value, so it's right at the floor price. At the floor price, it still has no intrinsic value, it's all extrinsic value, so it's at the money because it's right there. For a short, it would be at the ceiling price. Okay? Just keep that in mind. That's why it's called at the money.
The null point's the same for long or short.
Correct. The null point is the same for long or short. It does not matter.
Does that make sense, Jeff? Again, go look at the other things because, again, it's a lot different when you look at it from that perspective, where you say that at the money is different for long and short, whereas null point is identical in the spreads.
Okay, if you call up a graph, I can review it real quick.
Whoop, hang on. It's not what you wanted.
No. No, just, I mean, the graph from the presentation.
Yeah, this one I'm going to. But I went the wrong way.
Like even the first ones that you went over, you know, trading at the...
That's the easiest one.
Yeah, just...
Give me a second. We're getting there.
Oh, I'm patient. There we go.
Oop.
All right. So, the null point, you can see, if you were short this spread, let's just, if we were short it, the null point would be here. It would be in the middle of the spread, and if we're long it, we're in the middle of the spread. Okay, if we were short it, we'd be making money as it went down. If we were long it, we'd make money if it goes up. At the money, for if we're going long, would be the floor price. See right here, at expiration, it's the last point, at the money is the last point where it would expire exactly worthless. Once it's above at the money, which is above at the floor point, then you will make, you could possibly make money depending on where you put it on because it has some intrinsic value. Below at the money or out of the money, if it expires out of the money or even at the money, the spread will expire worthless for a long. For a short, you'd be putting it on up here, okay, and you'd be making money, it comes down. But if it expired right at the money and you were short up here, you would not be making anything. And if it was out of the money, this would be out of the money area for a short spread, you would not make anything. And then I talk about the ceiling price or the theta capture zone, which is above the null point and it's anywhere where you're capturing your extrinsic value. So it would be up here for a long trade and it would be down here for a short trade.
Anything else, guys? All right, looks like that's it. Thanks, everybody. Cheers. Appreciate you being here. Mike, thanks again. And Nadex, thanks again for having us.
Thank you,
Again,
everyone.
it'll be on, again, Tuesday of next week with some new stuff, some pretty interesting stuff. So
All new webinar next week.
same time. Cheers, guys. Talk to you next week.